Ladies and gentlemen, good day and welcome to Galaxy Surfactants Limited Q3 and 9 months FY24 earnings conference call. This conference call may contain forward-looking statements about the company, which are based on the beliefs, opinions, and expectations of the company as on date of this call. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Unnatan Shekhar, Promoter Managing Director from Galaxy Surfactants Limited. Thank you, and over to you, sir.
Thank you. Ladies and gentlemen, a very good afternoon to all of you. Thank you for being here. It gives me immense pleasure to welcome you all to this Q3 FY24 quarterly earnings call. Patience, persistence and perspiration make an unbeatable combination for success. This simple yet powerful quote by American author Napoleon Hill highlights the importance of the 3 P's across various spheres of life. Business is no different. While we all wish for success that is linear, volatility and uncertainties ensure success over the long run is always non-linear. It requires organizations to persevere, be patient, build on competencies, and persist in order to strike big when opportunities come knocking. Throughout the last 43 years, we have seen many such years where significant progress in terms of profitability eluded us, but these are also the years which set us up for big victories. The key was to remain patient, sharpen ourselves, persist, and build on the positives. The financial year 23-24 is one such year. While profitability might not reflect the progress made, the real positives lie in the market share gains, awards and recognitions received, resilience demonstrated, and the relationship fortified during the year. Starting with awards and recognitions which we received during the quarter, we are pleased to share that your company recently won the 2023 Excellence Award. This award was given under the Fabric and Home Care category by Procter & Gamble to its top 9 suppliers out of its 7,000 global suppliers. This is the second consecutive year that your company has won this award. We are the only Indian as well as Asian company to have won this award for 2 consecutive years. We also won the Supplier Resilience Award awarded by Henkel for our excellent operational performance in 2023. These successes provide a glimpse of the progress we have made with some of our key customers. Let me move on to the underlying business performance. While the underlying volume growth stood at 8.4% for the Q3 FY24, for 9 months the same stood at 8.5%, exceeding the 6 to 8% volume growth band defined at the start of the year. Given the receding effects of inflation and visible revival in demand, we are confident of meeting the upper band of 8% for FY24 despite the emerging challenges. While the quarter began on a strong note, the Red Sea escalation proved to be a dampener in the second half of December, leading to a spillover of volumes to Q4 FY24. The cumulative spillover was close to 2,000 metric tons, which is approximately 3% of our quarterly volumes. While the spillover does not adversely affect the business, rising freight costs and lead times pose greater risk. Further escalation remains the biggest risk going ahead. Barring North America, a healthy uptick in volume growth is visible across geographies. While masstige categories continue to do well, sustained uptick in premium specialty products holds the key for improvement in margins. While North America did see some sequential improvement, it yet continues to reel under the aftermath of excess inventory. Now getting to the specific volume growth numbers for YTD December, India continues to be the bright spot. YTD December, our volume growth stood at 13.6%, driven by performance surfactants. Despite the Red Sea escalation and currency volatility, the Africa, Middle East, Turkey region has grown at 2.3%. Rest of the world is slowly but steadily making a comeback, driven by masstige products. Rest of the world has registered 7% volumes growth for the 9 months ended December. Both our segments, performance as well as specialty, have done well. Performance has clocked 7.3% and specialty has clocked 10.8% volumes growth. As stated in our calls previously, volume growth remains the key prerogative. The numbers reported are encouraging despite the multiple global challenges, as volume growth signifies that the company, through its relationships and products, has been able to capitalize on the first sign of demand revival. Coming on to EBITDA per metric ton, which stood at 18,781 per metric ton for the quarter, below the guided band of rupees 19,500 to 20,500 per metric ton. This quarter, we had a couple of one-off impacts which adversely impacted EBITDA. Starting with the normalization of freight rates when compared to Q3 FY23 and significant increase in the second half of December, along with the spillover volumes to Q4 due to the Red Sea escalation. Cumulatively, these impacted the EBITDA by about 7 crores. Adjusted for this, the EBITDA would have come in the guided band. Export incentives earned in Egypt are only accounted on cash basis. The same stood at 21 crores for Q3 FY23, but was zero in this quarter. To conclude, ladies and gentlemen, long-term structural stories require patience, persistence, and perspiration to yield the desired results. India is one such structural story, and your company Galaxy is one part of it. We strongly believe if FY23-24 was the year of normalization, FY24-25 will be the year of resumption of our profitability journey in line with our business model principles. We remain confident and committed to ensure the same. Thank you very much for your patience, ladies and gentlemen. Thank you very much. We now look forward to your questions.
Thank you very much. We will now begin the question and answer session. Participant present on the audio bridge who wish to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the opportunity. So just a couple of questions. Sir, first, onto the Red Sea issue, as you mentioned, that so there was a spillover of volumes in Q4 FY24. So, sir, just wanted to know, so till now also the Red Sea issue hasn't been resolved. And are you seeing material uptick in volumes in Q4 also, or like we can see a spillover to even Q1 and Q2?
No. So, there's Natarajan here. So, see, when the Red Sea issue happened in December, when the shipping company decided not to take the Suez Canal route, there was a temporary suspension of sailings because they were deciding as to which route to take. once they aligned in terms of taking an alternate route, avoiding the Suez Canal, okay, then things resumed. Okay, so there was a halt in terms of supplies into Egypt, okay, and out of Egypt, okay, because of the sudden impact of the Red Sea blockade. Now things have resumed in the sense that now we know the sailings have resumed and they're taking a different route which increases your transit time. But now we don't see any issue moving forward. That was only temporary at that point of time.
Got it?
Okay. And sir, on to the one-off, you have mentioned, so 21 crore is the export incentive which was recorded in last quarter, which was zero.
Third quarter of last year, which was zero this quarter. We are comparing year on year, right? So when we compare year on year and quarter of last year and quarter of this year, we said in the quarter 3 of last year, we had a gain of 21 crores which came as export incentive in Egypt, which we account for only on a cash basis, only when it is received, but not when it is accrued. Now that was zero this quarter of this year.
Okay. So we are maintaining our EBITDA per ton guidance like for the next 2 years, like around 20-22 rupees per kilo, like that would be maintained?
We said 19,500 to 20,500. That is what is the indication that we have given to you.
Yeah, but then for the guidance that is the guidance we are given for this financial year. But for the next financial year, we'll have to wait till we end this year. Okay, so then we will then review the situation and then come up with a revised guidance if needed.
Got it. Then one last question. Sir, till now, sir, we are not witnessing inflation coming down so by a significant margins in AMET in North America. So any thought you have so this can slow down our volume growth over the next coming years? Is there any risk onto that assumption?
No. So one thing is we are seeing that Africa, Middle East, Turkey, the growth momentum commenced, although inflation is still a concern, but commodity prices have started coming down. Food inflation came down. Okay, so now only thing is that we do see after a brief lull because of the Red Sea blockade, things will come back. So that is our expectation. We do see things turning around for better and resuming the growth momentum that we had over the last 6 months. With regard to North America, we still see that the destocking is something that has probably bottomed out, and we are seeing that demand. We are seeing green shoots in terms of new demand, new orders being received by us, and we are confident that things should pick up moving forward.
What we are also seeing is that the home and personal care industry manufacturers have taken certain price calls or price decisions in terms of lowering the price, which also should aid in this resumption of demand in North America. I'm referring specifically to North America. Yeah. So we are seeing signs of revival in North America.
And similarly, sir, into the domestic market also, like the HPC manufacturers have taken a price reduction.
Yeah, so it will result in demand pickup. We do see rural demand picking up. Okay, so yes, it's good that these decisions are being taken. So it's the momentum in terms of growth growth demand in rural segments should pick up.
Got it. Thank you, sir. Thank you.
Thank you.
Thank you. Thank you. A reminder to all participants, ladies and gentlemen, you may press star and 1 to ask a question. Our next question is from the line of Arun Prasad from Avendus Spark. Please go ahead.
Good morning, sir. Thanks for the opportunity. So my question is on the volume growth that we have said it is close to 9%. And if you look at the fatty alcohol prices, it's almost from the third quarter, the decline is not more than 5%. So how do we explain the top line decline of 13%, given that 9% volume growth and 5 to 6% fatty alcohol price reduction? The 13% decline on the top line, notwithstanding the export the benefit that we got in the EBIT, but still, is there any gap in our understanding or in any prices which have shown a different trend as compared to the...
No. So I think, Arun, Natarajan, yes. So the 5%, because we also have contracts of earlier periods coming in. So I think that will not be the right way to look at it, because it is not that when the prices get revised in a particular quarter as per external reports, that reflects the price that we get. So it's not that sort of a correlation you're drawing is not the right correlation to draw. Okay. So it is in terms of, it also is in the previous period when you look at it, okay, as to what the mix was in terms of our pricing. So that's not the right way to look at it.
But even if I extend this analysis to 9 months, still if you look at the 18% drop, still most of the contracts should have renewed over this period.
So one of the things that you also should see is that the mix also has changed. If you look at overall volumes, the specialty products has come down. So that has a higher price products, correct? So when the mix changes, you also have the impact on the revenue, no?
Okay.
Yeah.
Right. Okay. So is this mix, especially specialty care products, this is only in India, or is it in the North American product? North American impact is having a very high impact on the overall impact? Because
you are right.
In India, it is not the case.
No, you are right that the impact on specialties has been particularly from the developed countries, both North America as well as Europe.
Right. Given the contribution from this geography in terms of volume is probably 1/3, still this is it the case of some of the margins in the underlying products falling higher than the what we have seen historically?
No, Arun. See, if you see the developed markets, that is North America and Europe, contribute disproportionately as far as the specialties are concerned. Okay, they have been impacted now for at least last 4 quarters, and we are seeing a revival or resumption only now. Okay, so slowly we would start coming back, and here is where we said that this coming period or this coming year, we would see a resumption of demand of these for these specialty products also in the respective geographies.
And what is the driver that is you are assuming this will revive, but what is the driver for this resumption? Is it the inflation or our market share gains also has to happen?
No, the driver is, one is, let us say, the emptying of the pipeline inventory which was there, which was plaguing the North American geography at least for the last almost 4 to 5 quarters or so. So one is the emptying of the pipeline, one. And number 2, I would say the inflation easing a little, okay? The inflation is still there in North America, but it has eased a little. So these are the 2 things which we think is a reason. But when we convey to you, this is in terms of what we are observing and what we are experiencing in those markets in terms of the demand coming back.
Right. Understood, sir. Within India, is our specialty portfolio now with the inflation easing off, and you said there is a revival, is it the chance of the customer upgrading? Because usually deflation scenario people will downgrade, but we are already seeing the signs of people switching to better products, thereby our specialty increasing, or it's still this trend within India is yet to be seen?
See, what we mentioned even last time, India is seeing a very interesting development, particularly in terms of home care. Okay, we see maybe in the context of convenience, we do see the home care market, that is fabric care, fabric detergents, experiencing good growth with respect to the premium detergent, what we call the liquid detergents. The liquid detergents which are today premium have seen pretty good growth over the last 3 years. They are continuing to grow. Maybe the base is small, but we are seeing that this particular category has been growing well. Similarly, the premium detergents also have grown well as far as fabric care is concerned over the last almost 1.5 to 2 years or so. So as far as personal care is concerned, the super premium specialties in India still remain a small percentage. India is still largely a mass and a prestige market as far as personal care is concerned.
Understood, sir. Thanks for this detailed one. My second question is on this Red Sea impact. When we said the freight is higher, do we have the ability to pass it on to the customers, or is it something like is it a temporary one, or is this something we can recover from the customers? How our contracts are structured?
No. So contracts. So what happened, Arun, was that immediately when it happened, when the freight rates went up, then there's a time by which you start passing it on. So first is clearly we have ability to pass on, but the suddenness with which it happened, it didn't allow you to pass on immediately. So very clearly there is an ability to pass on, and we are passing on. And we do see that these rates, so it's not temporary, increase is not temporary. Till the time the Red Sea issue continues, the blockade, the freight rates are going to be higher.
And then this is only a concern for India business, or for AMET also this is a problem?
No, so essentially this is only for business so Egypt actually sources good amount of its requirements from Asia and also exports out of Egypt into US. So obviously you will have an impact, and India also serves Egypt, so there will be an impact in terms of incoming for Egypt as well as for the outgoing freight.
Understood. Thank you, sir. All the best.
Thank you.
Thank you. Before we take the next question, a reminder to all participants that you may press star and 1 to ask a question. The next question is from the line of Anupama from Ratnatraya Capital Partners. Please go ahead.
Sir, this is Pawan. So I just wanted to understand last 4 years, if we look at the volume performance, it has been around 4% or so. Our guidance band is somewhere around 8%. So I just want to understand I understand last 2 quarters we have delivered 8% kind of volumes, but going forward in the medium term, what gives us confidence that that is the right band? Because last 4 years, the cadence has been relatively lesser.
Okay. So let us talk about, maybe I have to give you an historical context and historical perspective. See, India used to have a growth rate of around 8 to 10%. The global market used to grow at something like 2 to 4%. Okay, and so based on our product mix and the characteristic of the various geographies, we used to give or indicate a growth range of about 8 to 10%, and this I'm talking about maybe about 6, 7 or 8 years back. Now then COVID hit us. Okay. Now, COVID, the year was a very, very different year, okay, and it didn't reflect the secular trend that one used to observe, in various markets and geographies and various countries. So there was what I would call a temporary upsurge in terms of consumption, driven by the need for, cleanliness and care across various geographies, and this was also plugged with the supply chain disruptions which made manufacturers, that is our customers, draw more from us in terms of their ingredients. Now the after effect of this was seen in 21-22, where there was a double whammy, both in terms of where they had over-ordered one, and there was a huge supply chain disruption across the world. Okay? And there was a huge freight upsurge again that we had seen, both supply chain disruption as well as, freight upsurge. So that was a time that we talked about or scaled down our volume growth indication. So in 21-22 and 22-23, we talked about an optimistic band of around 6 to 8%. Okay? And in terms of historical, I think we didn't even achieve, we were there around the, at the lower band. Now, we felt as far as the beginning of this year is concerned that the demand was slowly coming back. And again at the beginning of the year we had given an indication of 6 to 8%. Okay? Now today when we are at 8.5%, you would say, this has come on the basis of whatever I mentioned in the initial speech. It has come out of our relationships, certain market share gains, as well as the revival of demand which started happening, in quarter 2 and quarter 3 outside of the world. India has remained a very, very strong story. Okay, so you would have seen that in India in the last 6 quarters or 8 quarters we have grown consistently. So this gives you an historical background in terms of the volume growth. It used to be 8 to 10%, then it came down to 6 to 8%, and then now we say, look, going forward, we would like to look at maybe 8 to 9% in the coming year. Does that answer your question?
Yes, I had one more question. On the EBITDA per ton, if I look at it, last year number, of course, if I look at it from a historical perspective, looks pretty odd at around 23,000-24,000, if I'm right. So, how many years do you think it would take us to actually get back into that kind of band again?
See, we did explain. See, we did explain even during those times that a lot of those gains were also opportunistic gains. Okay, one. And number two, certain disproportionate product mix during those particular quarters. Okay, we did caution and we did moderate the expectation during those times that we would look forward to normalization of EBITDA. And that's how in the beginning of this year we said we would like to give you an indication of 19,500 to 20,500 EBITDA per metric ton, which we would like to maintain, and as Mr. Natarajan said, we would relook at it in the first quarter.
Okay. And just one last question now on the volume side. So basically, if we are looking at 8 to 9% volume kind of growth, we are looking at almost like 15% volume growth in India. Is that the right assumption?
No, need not, because we also see growth coming back in Africa, Middle East, Turkey. We are also seeing in US and Europe coming back. So it's not that India needs to be at 15%.
Okay. You think you can manage it with below 15% also, 13 or 12% also? Can you manage those numbers?
No. We would like to grow India also at 15%. I'm just saying that if you have to deliver 8 to 9%, doesn't
grow in India.
Yeah. Okay. Yeah.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So, my first question is, you mentioned that there was some spillover from Q3 to Q4 in terms of volumes. And given that we have grown by almost 8.5% in 9 months, and you alluded that probably will grow at higher band of 6 to 8%, are we expecting some volume decline during the current quarter, and it could be related to the exports issue or the Red Sea issue? Any comments on that? Thank you.
Yeah, good question. While Rohit, we are seeing a demand resumption, we have to be cautious with respect to the Red Sea issue. Okay? So let us be optimistic and look forward to this particular quarter. Okay? So we have certainly factored the Red Sea disruption.
Sure, sir. That helps. Second question in terms of our CapEx for the 9 months this year and any guidance for FY25. I think we've been saying that it will be in the range of 150-175 crore. Just wanted to hear it from your end.
Yeah. So this 9 months, we have a CapEx of about 90 crore rupees, and we are on in the guidance of the same that we already mentioned about 130 to 150 crores for the year.
Sure. And one just...
Yeah, as you said, we are in line with a CapEx expenditure. By the end of the year, it will be around that 130 to 150 crores. Yeah.
Sure, sir. Just one last clarification. So, we just mentioned in our commentary that the North America, we are seeing some pickup which is happening, probably early signs. And given that generally, if the premium specialties are going up, that should construe to better EBITDA per metric ton. So is it a fair assumption that if North America picks up in Q4, Q1, again, we will move to closer to that band of 19,500 from whatever we are currently having?
That is the estimate. You are right. As North America picks up and Europe picks up, we would see the resumption with respect to the specialties, and we would expect to see the margins going up there.
Sure, sir. That's all from my side, and best of luck. Thank you.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. Our next question is from the line of Aditya Khetan from Smith's Institutional Equities. Please go ahead.
Yeah, thank you, sir, for the follow-up. So my first question is, sir, recently in January 24, so one of our competitors has announced a 600 crore investment into its oleochemicals and surfactants business. Sir, how do you view this as a risk, or like any comments from your side, like are they like so targeting the domestic export, and how things will go ahead?
So we have no comments on what competition is. We are very clear what we need to do, and competition always gets the best in us out. So it's okay. So they will do what they need to do. We will do what we need to do. So we don't see it as a risk.
Okay. So like, are we foreseeing any sort of an increase in competitive intensity or anything?
So competitive intensity has always been very high, and we have grown despite the competitive intensity, and we'll continue to do the same moving forward.
Okay. But onto our specialty mix, sir, you have said that the specialty mix has gone down. Any numbers that you can give out, like, so 60 or 65 performance, so how much decline into specialty we have seen, that mix number?
So actually, specialties grew this quarter, no?
And for the year also. For the year
10.8.
The growth in specialties was 10.8% for the first 9 months of this year.
Okay, to one of the earlier participants, you mentioned that mix has gone down, so I was wondering on it. Okay. Okay, sir. Yeah. Thank you, sir. Yeah.
Thank you. Ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Krishan Parwani from JM Financial. Please go ahead.
Yeah, hi, sir. Thank you for the opportunity. Just one question from my side. So this is our understanding. I think prices of some of the key products, let's say, which you sell in the performance product, are still 10% above the long-term average. So is it possible that on a sustainable basis, our per kg EBITDA could be more like 16-17 rupees per kg? Even, let's say, taking into the consideration the higher share of specialty?
Yeah. No. We don't think so.
Okay, so you don't see the price drop in, let's say, the product like SLES, CAPP?
We don't think so.
Okay, no problem. Thank you. Wish you all the best.
Thank you. The next question is from the line of Nirav Jimodia from Anvil Research. Please go ahead.
Yeah, thanks for the opportunity, sir. So I have two questions. So one is on our production capacities in India spread across the three locations, Tarapur, Taloja, and Jagaria. If you can just help us out, what is the current capacity utilization between the three plants put together?
Approximately all put together, we are at about 70%.
Okay. And sir, let's say at this 70% utilization, how much would be exported out of India and how much would be used for domestically here in India to sell?
I think from India.
So overall, if you look at it, overall our export is about consolidated revenues is about 65% and domestic India is about 35%.
Okay, so let's say if we are producing 100 here in India, 30 is exported out and 70 is used.
No, we are talking about consolidated. We are talking about total international business for us is approximately 65%, and India would constitute 35%.
Yeah.
That is on an overall consolidated.
And that is what we would always like to be sticking to. So we don't want to be getting into specific India specific. How much is exports and how much is domestic?
Got it. And let's say whatever is exported out of India would be predominantly the specialty volumes, or because Egypt generally serves the performance surfactant, so the good proportion of volumes going out of India would be more of on the specialty side, or how the mix looks there?
Yeah, all products contribute to these exports. Okay? All products contribute to these exports.
Got it. So second question is on one of our slides we have mentioned about the revenue breakup for 9 months between the three geographies. Is it possible to share the volume breakup between the three geographies, how it looks like?
No.
Got it, sir. Okay. Thank you so much, sir, and wish you all the best.
Thank you. The next question is from the line of Prolin N, who's an investor. Please go ahead.
Yeah, hi team. Just one question from my side. When you are giving a sort of guidance of 8 to 9% volume growth, and North America is also, you are assuming that will recover. So, when you interact with some of your customers, is there a risk that when they do their inventory restocking, so to say, they might not go back to their previous levels because of a higher interest rate environment? Is that a risk? Can then the recovery in terms of volume or even sustenance of volume, can it be delayed by a year? What's your comment on that, sir, since you have looked at the whole industry for a very long period of time?
So one thing that we need to know is that they have all our customers also think through, and before they start reordering, they'll also take a hard look whether when they start reordering and start reinstating the inventory levels and the pipeline inventory, whether they do see a risk of the demand not really coming back. So if they have waited this long and started coming back, it's only fair to assume that the demand would be positive. Demand growth would be positive moving forward.
Sure. So I was not, commenting from a demand point of view. What I was saying was that, every company will look at their own balance sheet, right? While restocking and cost of financing has probably gone up. So what I was trying to understand was that even if demand comes back, do you think that they can do with lower inventory levels than what they have done in the past?
It's a possibility.
No, but what I would say is that in this market, okay, when there is a demand uptick that is being looked at, I think they would always like to be having higher inventory to be catering to demand, because losing a demand, okay, is not something that you would like to afford.
Fair point. That's it from my side. Thanks a lot and all the best.
Thank you. The next question is from the line of Bhavin Soni from Anand Rathi. Please go ahead.
Hello, sir. I just wanted to get a clarification regarding the 7 crores impact on EBITDA you had given earlier on the commentary with respect to a one-off.
Yeah. So what we said was, the quarter had a couple of one-off impacts. So one was the normalization of freight rates when compared to quarter 3 FY23, which happened in normal, quarter 3 FY23, but there was a significant increase in the second half of December. This, quarter 3 of FY24, that was one. Due to which there was obviously a spillover of volumes of which we said, which went into which has gone to quarter 4. So cumulatively, these impacted the EBITDA by about 7 crores.
Okay. Thank you. That's it for that.
Thank you. The next question is from the line of Anubhav Sahu from Macpro Research. Please go ahead.
Hello. Hi. Thanks for this. So a couple of questions. So one, for the Q3, so what was the volume growth for India domestic business? And incrementally, what demand trend are you seeing for the rural areas?
So India grew by about 13.5%. Okay, and then see what is expected. The demand, rural demand was actually negative. That's what the commentaries from our customers say, which has started turning around in terms of a positive growth trajectory. So it's probably in the zone of about 2% to 3%. Now it is expected to pick up as we move forward.
Okay. And as far as the spillover of volume from Q3 to Q4, so which geographical areas were impacted because of this?
So it's only Africa, Middle Eastern.
Okay. And for Q4, I guess now this increase in freight cost is already getting factored in the new supplies which we are sending to customers?
Yes.
Okay, that's all from the segment. Thank you.
Thank you. The next question is from the line of Anupama from Ratnatraya Capital Partners. Please go ahead.
You mentioned that the freight cost has come down. So can you give us a normalized rate going forward?
Sorry.
Freight cost per metric ton.
Freight costs have gone up. Now, we talked about freight costs, normalizing in the previous year. Quarter 3 of previous year, okay? As a matter of fact, the freight costs had normalized even up to September of 23. Okay? We started seeing this jump in freight once the Red Sea issue started escalating.
So Q4, can we expect pretty much an elevated freight cost as compared to Q3?
Yes.
And what about FY24?
We don't have a crystal ball in front of us. It all depends on how the Red Sea crisis pans out.
Yeah.
If it gets better and things get resolved, it will come down. If it gets worsened or continues to remain where it is today, it will be higher. So it's something that we are not in control of.
And what is your guidance for capex for FY25?
Similar. It will be similar. Yeah.
I mean, we have been saying that we have been doing capex of about 130 to 150 crores in a financial year, and that we continue for the next year also.
Okay. Yeah, that's it from my side.
Thank you.
Ladies and gentlemen, that was the last question for today. As there are no further questions from the participants, I now hand the conference over to the management for closing comments.
Thank you, ladies and gentlemen. Thank you for your time. Wish you all the very best. Thank you.
Thank you. On behalf of Galaxy Surfactants Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.